For months, the economic weather forecast has basically been all clear. We were looking at cooling inflation, a gentle return to normal, just smooth sailing overall. But as we're about to see, the week of July 2026 is shaping up to be an abrupt, violent storm. The global economy is facing a massive, high-stakes stress test right now. And central banks, well, they are about to be put squarely in the hot seat.
Just last week, the economic picture actually looked incredibly promising. It was a perfect Goldilocks scenario, right? Not too hot, not too cold. U.S. headline inflation cooled sharply to 3.5% year over year, and even better, the labor market slowed down without completely collapsing. Payrolls added a modest 57,000 jobs, and unemployment held perfectly steady at 4.2%. This is exactly what policymakers wanted to see. It strongly signaled that underlying price pressures were finally moving in the right direction, which left the Federal Reserve with a much softer inflation backdrop and absolutely no immediate labor market emergency to panic over.
But then, the geopolitical situation deteriorated literally overnight. The benchmark West Texas Intermediate, or WTI crude, abruptly jumped by over $11 in a single week, settling at $82.49 a barrel. And why did this happen? Intensified fighting has led to severe commercial disruptions in the Strait of Hormuz. So, suddenly, that comfortable disinflation narrative we were just talking about completely shattered. The risk premium attached to global energy supplies is skyrocketing all over again, and it is throwing a massive wrench into the global economic outlook.
Section 1. The oil shock returns.
It is one thing when oil prices tick up slightly just because of normal, healthy economic demand. But a sudden, violent spike driven by military conflict? That creates an entirely different beast for the global economy to digest. And this sets up the absolute central dilemma for the week ahead. Will underlying inflation prove too persistent for central banks to simply wait this out? Or, to put it another way, are economies healthy enough to absorb this blow? Or are they already way too fragile and vulnerable to a renewed inflation problem?
Let's actually define what looking through means in central bank speak. The immediate effect of an oil shock is super predictable. Your gasoline and utility costs go up, but central banks won't necessarily hike rates aggressively just because gas is more expensive. Why? Because raising interest rates cannot magically produce more oil, reopen a shipping route, or end a military conflict. If an economy enters a shock with falling services inflation and moderate wage growth, the central bank actually has the luxury to simply look through these temporary, direct price effects at the pump.
Section 2. The central bank dilemma. Okay, so here is how a foreign crisis morphs into a domestic nightmare. It's a terrifying domino effect called second-round inflation. Step 1, your gas and utility bills spike. Step 2, workers realize their paychecks just aren't cutting it anymore, so they demand higher wages. Step 3, to actually afford those higher wages, companies start raising prices on everything else. Suddenly, an oil shock overseas has forced the price of your local groceries and haircuts up across the board. Inflation expectations rise, price-setting behavior completely changes, and central banks are essentially forced to act. So the really crucial point to remember here is that this week's inflation reports are entirely backward-looking to June. Honestly, it's kind of like looking in the rearview mirror while driving straight into a storm. These reports cannot capture the latest phase of the escalation that happened in mid-July. What they will do, however, is reveal each economy's starting position. They're going to tell us exactly which countries were entering this shock with elevated wages and sticky services inflation, meaning they have zero room to look through this new crisis, and which countries were actually already cooling down.
Section 3. The global economic divide.
When a massive shock like this hits, we simply can't look at the global economy as a single, unified entity. It actually splits right down the middle based on energy. We are seeing a stark, undeniable contrast between energy exporters and energy importers. Exporters, like Canada and Australia, actually gain some national income support from stronger commodities, even though their own citizens are paying more at the pump. But energy importers, like Europe and Japan, they suffer a direct, immediate deterioration in their terms of trade. And for Japan, this is heavily magnified by a historically weak yen, which makes all that imported oil even more expensive domestically. This rapid-fire timeline of data drops from Monday to Thursday is essentially a real-time diagnostic test. Monday establishes the inflation baseline with Canada and New Zealand. Tuesday tests the UK's wage story and Japan's import costs. Wednesday delivers the critical UK domestic inflation test. It's a total gauntlet of data, leading right up to Thursday, which brings us to the most important scheduled event of the entire week, the European Central Bank decision. Thursday is absolutely pivotal because Europe is a major net energy importer with really fragile growth. Higher oil and gas prices are actively reducing household purchasing power and raising corporate costs right now. So the ECB is testing whether they need to signal a September rate hike to fight off imported inflation despite this incredibly weak growth environment. Ultimately, the actual rate decision might matter a lot less than whether ECB President Christine Lagarde views this oil increase as a temporary headache or a serious second-round inflation threat. Her view matters immensely. It literally dictates the borrowing costs, mortgage rates, and financial stability for millions of Europeans.
Section 4. Flash PMIs, the ultimate test. Backward-looking data can only tell us so much, which brings us to the ultimate real-time lie detector, the Friday Flash PMIs. These capture business conditions right now, in July, while the disruption in the Strait of Hormuz is actively unfolding. During a normal cycle, weak economic data is actually good for markets because it brings expectations of rate cuts, but an oil shock totally changes the math. If we see stronger activity and lower prices, we're absorbing the shock. That's a soft landing. But weaker activity, accompanied by higher prices, that is the most dangerous outcome. That is stagflation. It tells markets that economic activity is deteriorating, but central banks remain completely unable to ease policy to help. Bad news becomes genuinely bad news again.
While the headline activity index is always important, the specific underlying components of the PMI report will provide the first real, broad evidence of higher energy costs actively spreading. We need to look incredibly closely at input costs and output prices. If these are rising while new orders and employment are falling, we have concrete proof that the energy shock is bleeding straight into July business conditions, forcing companies to pass costs along even as consumer demand falters.
Section 5. 4 week-ahead scenarios.
Let's tie all of this backward-looking inflation data and real-time PMI data together into actionable expectations for you. Keep this mental checklist handy as the news breaks. Our base case is that the June data remains benign, but central banks stay stubbornly cautious and hawkish because the oil shock is completely unresolved. Alternatively, we could see an upside surprise where inflation was already broadening before the oil spike, which would force bond yields higher. Now, if we get lucky with disinflation and a de-escalation in the Middle East, risk assets will absolutely rally. But the worst-case scenario is severe escalation. The conflict expands, oil spikes violently, and we are thrown headfirst into stagflation and broad market sell-offs.
Ultimately, no single CPI number changes everything this week. A minor beat or miss on Wednesday's inflation report really pales in comparison to the headlines coming out of the Middle East. The single most important live variable dictating all of these scenarios is whether the conflict in the Strait of Hormuz de-escalates or expands. A meaningful reopening of Hormuz would lower inflation expectations and improve the growth outlook almost immediately, absolutely overwhelming any spreadsheets or scheduled economic releases.
And that leaves us with the ultimate question as this economic thriller unfolds over the next few days. Are central banks totally trapped by this oil shock, or is underlying inflation cool enough to just wait it out? More importantly, if stagflation does actually take hold, is your portfolio and your paycheck ready for a world where central banks are totally powerless to come to the rescue? Thanks for joining me on this explainer. Keep a very close eye on those Friday PMIs, and I'll catch you next time.